Hello everyone. In today's session, I'm going to share a few of the highlights of the 2021 Sci-Fi report that gives us a window into investor behavior on the Momentum Wealth platform over this period. Now, a renowned German military strategist Helmut von Moltke famously said, and I'm paraphrasing of course, "No battle plan survives contact with the enemy." Unfortunately, investor behavior in 2021 shows that fewer and fewer investment plans are surviving contact with financial markets either. Let's begin by looking at the overall behavior tax for 35,000 Momentum Wealth investors performing switches, over 130,000 switches in fact, from 2006 until 2021. The diagram shows how the behavior tax intensifies in times of market turbulence. Now, a quick reminder, if an investor holds Fund A and switches to Fund B, we continue to track Fund A as the theoretical buy and hold portfolio and compare this with Fund B at the end of the year. If Fund B performed lower, the difference is recorded as a behavior tax. Now, there were three important things that this diagram shows us. The first is the asymmetry. So more people are destroying value when compared to those adding value by switching. The maximum annual value gained since 2006 was around 3%, while the maximum value destroyed, on the other hand, was nearly 10% per annum. The second important thing is that the behavior tax accelerates rapidly during periods of market turbulence and decreases rapidly, becoming negative in a bull market. We can see elevated levels during the global financial crisis, or GFC, that quickly dissipates during the subsequent bull market that ended in 2014. As markets become flatter and volatile, however, quickly the behavior tax once again accelerates and becomes more and more severe. Clearly, during the COVID-19 pandemic, levels far exceeding the global financial crisis were recorded. In fact, 6.5% on average in 2020 versus a maximum of 4% during the global financial crisis. The third, final, and most important lesson, though, is that market turning points are unpredictable, and this unpredictability causes a hefty behavior tax. The fact that investors didn't predict GFC or when the subsequent bull market ended in 2014, or the global pandemic, of course, that was COVID-19, means that on average, people always erode value from switching over time. Now, this is a good opportunity for a quick cautionary note as well. There is a lot more uncertainty at the moment with the current conflict. Although this perhaps hasn't quite reflected in markets as yet, switching money around in periods of elevated uncertainty, as history shows us, is always unwise. Remember, we're talking about an average behavior tax here as well, but the average is hiding the thousands of investors destroying double-digit proportions of their savings. This is just an unnecessary drag on people reaching their investment goals, and investors not reaching their goals has been predicted by many to result in what we call the 3 Ds for the financial advice industry. And these are dissatisfaction, distrust, and ultimately disintermediation as investors look at alternative distribution channels. Concerningly, there does appear to be a hint that disintermediation is a little closer than we'd like to believe. A global trend of greater engagement between investors and their savings appears to be a consequence of COVID-19. This is likely from the greater levels of uncertainty the pandemic has brought, and of course, during uncertainty, we like to try and reduce this by taking more control. Naturally, people also have more to lose, which is going to amplify loss aversion. S&P Global report that US consumers have an additional $1.6 trillion in savings since 2020. Our cars are spending more time in the garage. We're not stopping for that Starbucks on the way to work in the mornings. And we're making our own lunches and dinners at home. In Canada, savings to GDP is up over 80%, and in South Africa, it's up just a little over 20%. Concerningly, however, is a recent Canadian survey that shows particularly younger respondents, that's Gen Zs and millennials, are planning to ditch their financial advisors and handle their own investment planning in 2022. The main reasons that you can see on your screens are 54% of respondents want to save money on fees. Now, when we talk about fees, what we're actually saying is the perceived value of advice for these clients is too low. We're all happy to pay for something when we can see the value. This may be linked to a previous point where investors are not reaching their goals. 42% want to have more control, and this is linked to the 25% that go on to say that they don't want to go through a financial advisor to execute on investment decisions and transactions. So once again, this is a perceived value issue. Also noteworthy is that 25% of respondents feel they're knowledgeable enough to meet their own investment goals. So a challenge we as an industry are facing is pretty much around people's overconfidence. Now, if you doubt the power of the overconfidence bias, think the Titanic, think Chernobyl, and the Challenger space shuttle, all of which can be easily linked to overconfidence. In fact, Nobel Prize winner Daniel Kahneman is quoted as saying that if he could wave a magic wand and get rid of just one bias, it would be overconfidence, simply because it often stands between us and critical thinking. There have been a number of studies that have shown that proper financial advice is very valuable. Russell Investments have calculated the value of financial advice at 4.83% per annum. Now, we can debate that, but the 2.02% value they attach to behavioral coaching makes sense if we look at the behavior tax over time we've just seen, and in fact, in certain times, it may actually be much more valuable than this. A behavior tax we haven't even quantified yet, for example, is the one associated with investing too conservatively over an extended period of time. We've identified a large group of investors we call the avoiders, for example, that invest fairly conservatively and then just kind of get stuck there. The behavior tax in this case is the cost of investing in cash versus that of a well-diversified and inflation-beating portfolio over time. We've already discussed two prominent behavioral biases that advisors play a crucial role in managing. Firstly, the financial advisor has a critical role to play in managing investor overconfidence in the information age. This will no doubt be confounded by the self-serving bias. When good investment decisions are made, they're often mistakenly attributed to our own skill. When bad decisions are made, they're brushed off and attributed to bad luck or circumstances beyond our control. This is to protect our ego. The second and equally destructive bias is loss aversion. So losses hurt, and we're desperate to avoid them. Related to this is the action bias. In an attempt to minimize the discomfort that market panic brings, instinct propels us to just do something, when in fact the opposite would be far more beneficial. The role of the financial advisor as a behavioral coach here is critical, but will also require some new skills. The CFP board has recently included psychology in the global CFP syllabus that will focus on harnessing specific skills to manage these biases and bring to the fore the value offered as a behavioral coach. Moving a bit closer to South African investor behavior, we can see a similar and equally concerning trend of greater engagement between investors and their portfolios. In the 2021 period, there was an 80% increase in the number of active investors, or those people performing at least one investment switch. This was accompanied by a 50% increase in the number of switches to a record level of 27,994 switches. The average amount switched was just over 169,000 Rand, and the net result was a little more than 90 million Rand paid in behavior tax for the 2021 period. Now let's dig a little deeper into the roots of this 90-odd million Rand in value lost. Examining risk and return for the time period, it's clear that investors closely followed the ebbs and flows of market risk and return, but often arrive a little late to the party. The diagram on the left shows the Savvy or South African Volatility Index for the 2021 period. The higher market volatility in the latter part of 2020 was matched with predominantly risk-off behavior. Now, how we measure risk-off is basically to match the nearest asset allocation of the Momentum flagship OBI fund to the fund or portfolio switched from as well as to. A negative number indicates that on average, investors are moving closer to the more conservative CPI plus 2% end of the spectrum, or de-risking, while a positive number indicates that investors are moving closer to the CPI plus 6% end of the spectrum, or up-risking. Looking at this corresponding market returns from the JSE All-Share Index on the right-hand side, we can see that returns were comparatively low near the beginning of the timeline. The trend reverses very briefly, but then volatility spikes again, and in March and April, this is enough to keep investors predominantly taking risk off the table. Volatility then subsides, and returns come back to markets, a little more predictably, and the overall trend shifts to investors up-risking their portfolios once more. Finally, we can see that the number of switches during the more volatile period is more than 4 times as much as the latter period, at 6,500 switches on average per month, compared to 1,500 switches per month on average in the beginning. These relationships here are way too close to stem from coincidence alone. It's very unlikely that investors' goals are ebbing and flowing almost exactly to the tune of market returns and volatility. When looking at the trading volumes at the bottom of the diagram, it's almost as though investors or long-term investors are playing the wrong game. Their behavior is closer to that of the day trader that relies heavily on market volatility for short-term profit than to a long-term wealth creator relying on a good balance of assets to outperform inflation. Going into a little more detail and following investors as they switch between different funds, we can answer the following question. Are investors rewarded for making these tactical calls in their portfolios? We do this by examining the investment performance before and after the switch made. So what was the recent performance of the fund invested in or abandoned versus what happened in the next period? The top 4 rows of the table in green show some funds with positive net inflows. The Coronation Global Emerging Markets Flexible Fund, for example, showed positive net inflows of over 30 million rand. The preceding performance of this fund in 2020 showed a healthy 27.73% return. So, were investors rewarded for this? Well, not really. After switching into this fund, investors then earned a negative 9.32% for the year to follow. We can see the same trend in the other funds that showed net inflows. The Coronation Optimum Growth Fund showed inflows of over 8 million rand after generating 22.15% in the 2020 period. Subsequently, however, the fund delivered a negative 3.31% return. The Momentum International Income Fund and Flexible Income Funder funds saw inflows of 28 million rand and 74 million rand respectively after healthy performance of nearly 9% and just over 12% in 2020. Investors then, however, received slightly negative performance in the International Income Fund and 6.45% in the Flexible Income Funds, both substantially lower than the 2020 performance. The next 3 funds show successive examples of those with net outflows. So property as an asset class was absolutely smashed in 2020, and the Momentum Real Growth Property Fund delivered a return of negative 34.89% in an extremely tough climate. The fund saw net outflows of nearly 7 million rand. After investors had locked in this loss, however, the fund rebounded and gave a positive return of nearly 37% in the year to follow. The same trend was evident with the Momentum Focus 5 and Focus 7 funder funds with outflows of over 12 million rand and 14 million rand respectively, after performance of less than 1% in both funds for 2020. In 2021, once again, these funds delivered stellar performance of nearly 16% and over 18% respectively, with the investors having left these funds incurring a substantial behavior tax because they missed these subsequent returns. Today we've examined this concept of a behavior tax, how it's formed, and more recent elevated levels of behavior tax far in excess of what we saw in the global financial crisis. Investors are saving more and becoming more and more engaged with their savings. By using some machine learning techniques, 4 general behavior patterns have been revealed, and what is clear is that different groups or archetypes are destroying value at different times. The market timer, for example, is active in both up-risking and down-risking their investment portfolios, and this kind of archetype performs the greatest number of switch transactions, incurring the greatest behavior tax in 2021 at just over 5%. This is in stark contrast, for example, to the avoider archetype that switches the least, invests the most conservatively, and generally stays away from investment risk. This group incurred the lowest behavior tax of just over 1% for 2021. However, as we alluded to earlier, these investors likely incur a different kind of behavior tax as well. This leaves the assertive investor who is constantly up-risking their portfolio and switching to investments with better and better past performance. These investors incurred a high behavior tax of over 4% and also destroyed the most value, paying over 40 million rand in behavior tax of the 90 million rand in total. Finally, the anxious archetype, who is the most active in de-risking their portfolio and chasing worse past performance, usually when markets dip, incurred a behavior tax of just over 3% for the period. Particularly interesting is that in general with market volatility, the anxious investor is by far the worst affected. In 2020, by far the largest behavior tax was paid by the anxious investor as they scurried to safety when markets crashed in March 2020. Subsequently, these investors completely missed the market recovery, searching for more confidence before climbing back into risky assets. With a market recovery that only took around 3 months, this left anxious investors selling after the crash and buying back in after the recovery. In 2021, however, the ups and downs of markets have cost the market timer archetype much more. In up and down markets, switch frequency and herd behavior are being penalized much more. As we understand these patterns more and more, and as we start to examine psychometric and personality traits of these investors with our investment personality assessment, that's coming quite soon, we'll be in a great position to start nudging both investors and advisors to make better decisions for better investment outcomes. Because with us, investing is very personal.